Hey everybody, it's Mike Nelson at efficientlending.net. I want to thank you so much for stopping by my blog, my YouTube channel, wherever you're finding me on the web. Can't tell you how much I appreciate it when people take time to check out my online content. So, topic for today, and I'm going to explain this here in a minute, is going to be finessing your loan. And I'll give you the backstory about how I came up with this. It really happened last week, Thursday and Friday. My wife and I made another trip into Tampa. From our meetings we had a few weeks ago. Spent a couple days there working. Really had a great time. We stayed. My wife picked a place to stay in St. Pete Beach called St. Pete Beach Resorts. Easy for me to say, and really quaint place. It was a good place to stay. And then we got a recommendation from somebody we were meeting with to go eat at the Mill, which is in downtown St. Pete. Got to tell you, great restaurant. My wife and I are kind of quasi foodies. If you're ever in St. Pete, Tampa, Sarasota area, check out the Mill. I don't think you'll be disappointed. Back to the topic at hand. So I'm going to chat today about an idea I came up with during these meetings. It's called finessing your mortgage. And let me see if I can explode that and unpack it just a little bit so it makes sense. Just been listening to a lot of real estate agents, reading a lot of their content that agents are posting online, social media, etc., about mortgages. And then I hear a lot of radio advertisements. I read a lot of articles online, and I got to be honest and tell you, I think a lot of the content that I'm seeing online is just not really capturing the nuances of what a mortgage really is. Kind of took that feeling and realized that, when I'm working on files for borrowers, there's a lot of times where, I'm dealing with tenths of percentage points or even hundreds of percentage points for things like DTI or loan to value. I mean, these are binary type numbers. In a conventional conforming loan, Fannie Freddie, 80% loan to value is no mortgage insurance, 80.01 is. And so what I found myself doing is a lot of just really kind of extenuated analysis, really trying to understand what these borrowers need, looking at the products that are out there, both long and short term. And I realized, I'm just not slamming loans here. And that's what I sense I get in a lot of advertising I see and I hear. I'm really finessing these files. I'm really trying to make sure that I understand what the borrower needs and how the product works. And sometimes we're at razor-thin margins where even rate risk between the application, float, and lock can put a deal in a completely different category. So I just decided I'm going to do a series called Finessing Your Mortgage. And this will be number one in I don't know how many it's going to be. But the topic for today is going to be on the importance of term. And I will tell you, and I think a lot of people disagree with me on this, but I'm going to tell you, by far, in my opinion, the most important part of any mortgage is the term. It is not interest rate. So much so that I think interest rate is probably 3 or 4 on the depth chart of importance as it relates to a mortgage. I think term is number one, and I think that's where really people should start to get this big picture sense of how we're going to get the borrower into the best product. So I think I've got some math that can support that, and I'm going to work through an example here for a few minutes, and hopefully this will make sense to you and clarify any questions as to why I believe term is the most important part. And once you understand term, you can really start to finesse the finer details of a mortgage to the best advantage for the borrower. All right, so let's make some heads or tails out of this statement that I've made that I think term is by far the most important part of really a mortgage, and we'll get to some math here in just a second. So the first step is let's just make sure everybody's on the same page with a few definitions. The term is the length of a mortgage. So you can have a 30-year, 25, 20, 15-year mortgage. The period is the length of time between each payment. So for example, almost all residential mortgages have monthly payments, so the period is 1 month. So a 30-year mortgage has 12 times 30 or 360 periods. Pretty easy to get there. So why does term matter? And I just want to say up front that I've talked to a lot of borrowers, and what I've found is it doesn't matter how wealthy and how much education you have. I mean, a lot of doctors may not understand this, and people that don't have that level of education may get it easily. So it's really not wealth, stature, success, and I'll tell you, I think mortgages are subtle, and I think they're nuanced, and I don't think they're really as intuitive or as obvious as everybody might think. So let's just go ahead and take this example, and let me just start, and let me get the disclaimer out of the way. I am not advertising interest rates here. I am not suggesting that these interest rates that you're about to see from me even reflect market conditions. This is purely an example to show how the relationship of time and interest works in a residential mortgage. So clearly not an extension of credit. I'm not offering credit. I'm not offering these rates. I certainly have not shown any APR in these examples. So just the disclaimers out of the way. Okay, here's the example. Let's say, for example, we look at a 15-year fixed rate mortgage, $250,000 balance that has 6% interest rate. You can see that your monthly P&I payment, just principal and interest only, is just over $2,100. And if you took this loan to term in 15 years, you'd be almost paying out almost $130,000 in total interest over the term. All right, let's continue on in the example. Let's say now instead we're going to look at a 20-year mortgage. Notice I've lowered the rate a half a point, and I'm intentional about that, which is I'll show you in just a second. Now the rate we're going to look at is 5.5%. You can see your monthly principal and interest payment, and you're almost at $163,000 over the course of the loan. And continuing on, let's say now we want to look at 25-year instead. Notice again 5%, my interest rate's going down. Your monthly payment is obviously going down pretty significantly from the 15-year. And now we're at just over $188,000 of interest spent over the term of 25 years. Last but not least, the conventional conforming loan that everybody just kind of defaults into is a 30-year fixed, and then now I'm saying it's 4.5%. Look at this, your monthly payment has gone way down, $1,266, basically $1,300 a month. But holy cow, you are going to spend $206,000, nearly $207,000 in interest expense over the course of that 30 years. So the point's pretty obvious. This is what I'm trying to show. The term is important because look at this example. The highest rate on this page is 1.5 points higher than the 30-year fixed. It's 6%. And yet over 15 years, if you can handle that payment, you're going to spend, I don't know, $76,000 less over for the cost of your mortgage. So clearly, term is the one impacting your total expense on this mortgage versus necessarily the interest rate. I want to make sure people can see that there because most people wouldn't guess that. Number two, most people wouldn't think that the total interest on a $250,000 loan over 30 years is $206,000. I mean, what a huge percentage of the principal balance. So I just want to show those things there. The other thing is this, and I hear this in advertisements all the time. You'll hear an advertisement for a refi, something like this. Hey, save $50 a month, save $100 a month in your monthly payment. That is not necessarily a true statement. If, let's say, you're 22 years into a 30-year loan, you refinance back out to 30 years, even at a lower interest rate, yes, your cash flow may be less each month, but you are not saving more money because it's going to require more interest to be paid to pay off your house. Very important that those relationships are understood. Now, a couple things. Somebody's going to say, hey, Mike, okay, great. Your example's great. I can't handle a $2,100 payment per month. I can only cash flow $1,266. Okay, here is where the finesse comes in, and this is what I'm trying to drive the point out. Sure, that is a huge difference, 21 to 1,266. I totally get that. However, what if we do some nuance or some finesse? We look at different products, ARMs versus fixed. What if we say, hey, you know what? If we can retire just a little bit of debt, maybe you can get into a 25-year loan. Look at that. You're still saving significant money, $206,000 versus $188,000 in total interest paid. So that's important. The second thing is this. In virtually any residential mortgage, the majority, probably 65 to 70% of your interest expense will be paid in the first half of the term. So for example, a 30-year fixed mortgage, you will pay 65 to 75% of your interest in the first 15 years of the loan. Now, lenders, investors, we all know this. The average amount of time that a loan is alive in the United States before the house is sold or it's refinanced is just under 8 years. So the investor, the lender, is getting the vast majority of their interest expense prior to the loan getting very deep into its term. And so they're making good money. Now you can say, oh, the lenders and investors are big bad people and companies, but that's not really true. They're the ones that are putting up, significant money at risk, and they're the ones that have the money. So the point is this: use their money. Buy your house, get the home, but let's use finesse and nuance to make sure that we've maximized our opportunity to retire the debt and pay the least amount of interest expense we can. Okay, hope working through that example made some sense, and I'm going to go ahead and sign off here. This blog just a little bit longer than I usually like to go, but it's an important topic, and I also think it sets the table for great add-ons in the series. And here's the last thing I want to leave everybody with: what's in it for me. If you're a real estate agent, you really want to make sure that your buyers and your sellers understand how to leverage their mortgages to get the quickest amount of equity in their home that they can. Why? Equity is leverage. Equity is the way that you can, in your home, is the way that you, if you choose to, lever into buying new houses, selling, buying vacation homes, rentals, things of that nature. If you're a real estate agent and you keep up the relationship with your clients, you're going to get return business downstream. Listen, if you're a buyer or a seller, you want equity. I mean, you don't want to be paying interest to a lender. You want to be putting equity into your home, which in turn gives you leverage to really do things. You may want to buy boats. You may want to buy vacation homes, cars, whatever it is, college tuition. I don't know. But the point is that term is so important, and the what's in it for the agent, the mortgage lenders, the customers, the borrowers: lowest amount of interest rate, highest monthly payment for the shortest term. The highest monthly payment you can afford at the lowest interest rate, the lowest term, is what is creating the most equity in your home the fastest. Hey, listen, this is not an easy topic. I love to meet new people, love to chat with people. Feel free to text, call, or email anytime. More than happy to chat. And look, I wish you the best and the greatest of success. And sincerely, thank you again for spending some time with me online. Hope you have a great week.